Thanks so much for joining in. Rakesh, to begin with, you're fairly confident in the current environment and you believe that a broad-based rally is likely to play out for the markets. What's driving the optimism?
So, there are two things working here. One is that global markets are extremely supportive for a risk-on rally. And, clearly we have seen that the trade war between China and US has been, pushed off for now with the phase one deal being done. And number two, the central banks are pretty accommodative. So given all this background yesterday IMF also raised the GDP forecast for the, global growth. So all this augurs really very well for, as a backdrop for emerging markets to do well. Coming to India, we have seen, a slowdown and, we are at a decade low in terms of GDP growth. But, government has been making a lot of efforts and we will see continuation of these efforts into budget later this month. And that should be, at a turning point on the Indian economy also. So supportive global environment and inflection point on the GDP growth in India really makes me comfortable that this market has much more strength for 2020.
Now, we just had an interesting discussion, Rakesh, on what veterans within the infrastructure space are betting on for the budget. But there's a lot that we will be looking at as well from the budget standpoint in terms of, the overall sentiment as well that has been a bit on the downside. The finance minister needs to inject that sort of confidence into the economy. What is it that you're expecting on the 1st of February?
Okay, so from an infrastructure point of view, while the blueprint is already out, everybody is looking at the budgetary support to that blueprint, and which is where everybody will be looking forward to increased allocation. But apart from that, government has already done a few things which is likely to change the infrastructure sector very positively. One of those is resolution of arbitration awards and claims, and the recent notification which came out in late November, which allowed for infrastructure companies to claim 75% of the arbitration award by paying bank guarantee for the principal amount only. That is starting to make progress, and we are expecting that a lot of companies will utilize this scheme to shore up their balance sheets in the current financial year itself. Apart from this, we're also hearing that NHI is making an effort to resolve arbitration claims through negotiation, so which also really augurs well for the infrastructure players. The only missing piece is funding by banks to infra companies. Once that starts to pick up, I think infrastructure would be one of the most hot sectors to look forward to in the coming financial year.
So that's for the infrastructure sector, but on the whole, what is it that you're expecting? Tinkering with, the personal income tax rates, what are you expecting in terms of projections, other sectors such as agri, jobs, etc.? What is the expectation?
So, the expectation is twofold. One is obviously to kickstart consumption. Government can look at, giving relief on the personal taxation front. Also, there could be, some schemes like, scratch-based scheme for boosting auto demand, etc. On the other side, everybody is hoping that government will come out with a budget which has more allocation for capital expenditure, and I'm expecting that at least 10-15% growth would be there in capital expenditure side. So both the balance would be there, I think, driving consumption as well as supporting infrastructure and capital expenditure to boost growth. So expectations are extremely high, and hopefully they'll meet this time.
Okay, that's the view coming in. Budget aside, let's talk earnings. How have you read into the trickle of numbers that have come in so far, Rakesh, and what's the expectation as to when we can see an actual earnings recovery play out?
So clearly, the current earnings season has not been that great, and companies have been, showing weaker operating parametrics, even though the headline numbers are meeting the estimates, but operating metrics have been pretty weak. So, but I don't think investors will be fixated on these numbers, because this is, history, and this is a reflection of the credit squeeze that we had in the last few months, and the way GDP growth has come down. But things are, going to look much better in FY21. So I would think that investors are going to ignore the weaker earnings, and probably buying on dips would be the strategy most investors will follow.
That's the view coming in. Let's talk about the sectors that you're betting on. You've been maintaining the strategy of moving from the defensives to the global cyclicals. What exactly is the rationale behind that?
So global recovery is firmly entrenched, and that's why global cyclicals like metals have been first to start off the block. And I think there's still steam left in the metal companies, because the demand growth globally would be supportive, and supply is really constrained because of last few years of lack of investment. So I think metal companies will continue to do well in 2020. Apart from that, I think domestically we would be focused on two themes. One is obviously infrastructure, where government is focused on, and the other is revival in the consumption, where government can do a lot of stuff on real estate, and so that augurs well for even local cyclicals like cement, housing finance companies, and corporate oriented private banks. So all these sectors can really benefit from what the government is trying to do. So overall, risk on trade, so more focused on cyclicals than defensives.
Okay. There's also select pharma stocks that you like. But that would in some sense be the defensive play. So what is making you pick out some of these pharmaceutical stocks vis-a-vis, say, the other traditional defenses like maybe consumption or IT?
So pharma has gone through 5-6 year of downtrend, and has been consolidating pretty well, and most of the companies have been able to come out with the US FDA led issues. The margins in US markets have also kind of bottomed out, and now things are starting to look better. I'm also hopeful that given the current valuations, investors have been extremely pessimistic. So not only pharma companies give an opportunity on the earnings growth side, but there's potential for a PE rating also. So both these things combined, make me pretty optimistic that pharma could be turning around in the current year.
Right. Okay. So that covers mostly everything. So if you had to go with sort of one theme, Rakesh, what would that be going forward now into 2020, particularly post-budget as we head into the new fiscal?
So the main theme is going to be infrastructure and rural consumption for India, and that is also well supported by, as I said, the global economy doing well. So I think buying cyclicals here is the call.
For joining us this morning.